Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. 1 o'clock on the East Coast, Monday, the 8th of July. That's letter N for you futures players out there. Of course, June letter M, as in Mary. This is market call. Just the two of us today. Again, another one of these seemingly benign days in the form of the S&P 500. But, you know, once again, Dan, we're seeing things go up on one side of the ledger and down on the other. How are you?
I'm doing great, guy. We missed you. I mean, like, I think the risk reversal media fandom missed you last week.
Doubtful.
Hopefully,
well, last week was a short week. I mean, you didn't really miss me that much.
You know what? There were some goofy things that went on last week. I mean, like, you know, we had that jobs number on Friday. I know that you and Liz Young Thomas covered that on this morning's On the Tape podcast that probably dropped in your favorite podcast store not too long ago. So you're going to want to check that out. Guy, some other little housekeeping, by the way. You and I are about to go, and the whole team, on a little summer schedule as it relates to
what does that mean?
Market call. It means that we are going to do market call. We're going to take Mondays off. We're going to go heavy on the Monday on the tape with Liz Young. We're not going to do market call on Mondays, but we will be doing it on Tuesday, Wednesday, and Thursday. So we hope that you will tune in if you don't already on the Monday edition of the On the Tape podcast. All right. That's the little housekeeping we have. So next Monday, guy, no market call. I know it's sad, but we'll be back after Labor Day.
Listen, you know, if the market requires it, you know, maybe we'll jump in. But to your point, you know, we sort of the summer hours are kicking in. But, you know, my sense is unless something weird happens by September, we'll be back on Mondays, if not Mondays and Fridays. But, you know, we'll discuss as it goes. Let's take a look at the rundown, Dan Nathan, because why not? Amanda loves it when we do this. First point, calls for a correction. Well, not out of this one cat that I just saw from Oppenheimer, I think, who raised his price target to 5,900. He was just on one of those shows. I believe it was not the halftime report, the one before it. Earnings expectations versus the reality of earnings. Now, that's going to be an interesting conversation. A tale of two tech trades. Very true there. And if we have some time, a little audience Q&A. So queue up your questions now, Dan Nathan.
Yeah. You know, one of the things, Guy, that really struck me is in the time that you were gone, okay, we saw the reversal in the move 2 weeks ago in the 10-year U.S. Treasury yield. We got as low as 4.2, and we got as high, I think, as 4.5. And so after that jobs data, you know, we saw that reversal here. Here we are at 4.28. There you go. Which is, you know, interesting. And so what were the expectations, Guy, as you think about that? When you saw that move in yields, was it that we're going to have a really hot jobs number? You know what I mean? When you think about that. And you know, what's also interesting about that is if Amanda wants to draw a little trend channel there, it kind of got right up to the downtrend and got rejected. Look how good she is on the FactSet charts. You see that? And, you know, we'd make that red, you know what I mean? But look at her.
Channel.
It'd be interesting to see if you get to the bottom end of that channel, what does that get you to 4.1 or something like that, which would basically be a new low over the last few months.
Now, it's interesting, even if she wants to do even something more, because my eye is sort of trained to look at these things. If she were to go to the high yield that we saw in the fall, that channel, that lower band of the channel probably connects to that top.
Yeah.
And then you see we subsequently, if you look at it, then we broke out to the upside, traded back down. So that's the way my eye looks at things. And how close am I going to be on? Not that one. No. That other channel, the bottom channel, if you just extend that channel up, it probably goes to the October highs is what I'm saying. So while she's doing that, I'll mention this. Not only, keep going. There, you got to move up, whatever. I mean, it's the lower end of the channel that's the top. Anyway.
Yeah. I got you.
What I was going to say was, I also think if you really want to get down to it, and I'm not interested at all in talking about anything political, but I also think the move in yields might also be predicated on the fact that, you know, candidate Trump probably took a marginal lead over President Biden, given what's happened over the last couple of weeks. And I think the interpretation from our markets is, you know what? Lower rates are going to be coming in a meaningful way if he were to be the next president. So I think that might be part of this equation as well.
Yeah, no, that's a great point. And, listen, and you and I could debate that if there was some pressure about rates going lower, what that might mean for inflation. Just as you think that you have inflation going in the right direction, it might start going in the opposite direction. And then, one of the reasons why, and we've talked about this a lot, why the Fed might be inclined to raise or lower interest rates, somewhat aggressively, is because the economy's slowing, right? And we'll spend some time on the jobs report. I know you and Liz did this morning, but look what happened also while you were gone, Guy. Look at the CME Fed funds tracker there. September rate cut odds of 25 basis points is up there almost 75%, which is pretty interesting. And it'll be interesting to see. There's no Fed meeting in August. We know that we have that Fed symposium. I think it's August 22nd in Jackson Hole. What's signaled there? But it seems like the market is moving in one direction. And September was pretty low odds not too long ago, Guy. He might have frozen there a little bit, but you guys heard what I had to say. So again, I think that's pretty interesting. We lost Guy for a second there. So we're looking at a 74% probability of a 25 basis point cut. And then you have to kind of go back towards November, which is where a lot of folks thought they'd wait until after the election and start cutting interest rates. And you see that there's basically a 33% chance that yields are down 50 basis points by November, guys. So it's suggesting that really good chance of 75%, and then 33% chance that we're down 50 basis points by the November meeting or around
look, I mean, a lot. I think over the next couple of weeks, as we go into the Republican convention, then the Democratic convention, I mean, a lot's going to, I do think actually there's going to be a lot of market moving events, maybe not necessarily the stock market as the initial, but I think the stock market tangentially on the back of the potential move in the bond market. So we'll see. I'm just throwing that out there. So we talked about the sort of the have and have-nots calls for correction. Well, Mike Wilson's back in the news, Dan, and he says the chance of a 10% correction is highly likely sometime between now and the election. First of all, I'll obviously agree with that. I thought that was going to happen in the fall of last year, and it didn't happen, and I thought it would be more severe than that. But, you have Mike Wilson talking about things now as well. That, by the way, comes into faces, as I mentioned, some people raising their price targets. As a matter of fact, I think Lori Calvasina, who's on Fast Money tonight, raised their price target in the S&P to 5,700, I believe from 5,250 on Tuesday of last week.
Yeah, and it's interesting, we had Mike on the podcast, I think 2 weeks ago, and about 2 months ago, he had kind of reversed a bit of his bearish stance on the S&P 500. Now, Mike has been talking about for the last 18 months rotations, right, in different sectors and how he would be playing it in this rate environment and the growth environment and all that sort of stuff. But he got bullish on the S&P 500. So for him to make this call, which was tactical, Guy, and I think you will go back to 2022 where Mike made a couple great tactical calls. A couple to buy him. I think one was in June and one was in October, and a couple to sell. And I think Mike is really good on that sort of stuff. I just think that as we go into earnings season and you look at the way the S&P 500 has just blown out. I mean, it's literally it feels like a bit of a blow off sort of top. And you can talk about, the NASDAQ being up 3.5% last week alone on a shortened week with 3.5 trading days. That just felt like some goofy action. So again, every year on average gets a 10+% pullback. I think that pullback from April was almost 6%. So not enough there, Guy.
No, not at all. And, the April pullback I thought would continue. It did not. And, it got down to the moving averages and we bounced. I'll say this. I'm glad you mentioned 2022, because that was a year that actually made a lot of sense to me. I mean, I know you know this, but that was a year where the market, spent the majority of the year going lower, except for 2 times, one time in June and one time in October. Both those times is when the VIX traded, I want to say north of about 33.5 or so. So it was logical to me to see the market bounce within that downtrend. Obviously, last year was a head scratcher, and the majority of this year has been the same. So we'll see how it all shakes out. Next slide, though, I think is really interesting because it comes from our friend Rosie, and he's talking about some of the anomalies that are out there. And I agree with him. And Liz and I mentioned it earlier today, just the percentage, how, again, 5 to 10 stocks are driving 35% of the gains in the S&P, 24% of the earnings. I mean, the list goes on in terms of some of the exaggerations, I guess, or the anomalies that we're seeing in the market.
Yeah, so I love this quote. I read Rosie's, note every morning, or the daily note that he puts out very early. So the real bull market is in a growing list of anomalies and non-confirmations, and it's a great note. Check it out. The one thing I'd say about the S&P 500 is that you look at that move that it's had from those April lows after that 6% sell-off, it's up about 12.5% or so, but it's also up, considerably from that 200-day moving average. It's a pretty wide spread. I think that a lot of market watchers, when they see, that sort of spread between the 200-day and a major index like this, it's something to take a little note. And again, the market does not appear to be broadening out too dramatically, at least in sectors that have the ability, Guy, to move the S&P 500 higher. So thoughts on the anomalies and non-confirmations?
Well, the non-confirmation is coming in the form of a couple different things, not least of which the small caps in the form of the IWM, if you want to throw that up, which is probably trading around 202.5, 203 today-ish. But as I've mentioned probably 40 or 50 times on this show, 208 in the Russell has been resistance for the last year and a half, probably going on 2 years or so. And we're nowhere near, obviously, the prior all-time high that we saw if you go back probably what it was, the summer of 2021 or something like that. So there's an anomaly right there. I mean, the small caps are not at all sort of reinforcing the strength in the broader market. And just the anomalies just under the surface and the amount of stocks that are through their probably 50-day moving average to the downside. So again, we're just getting carried by, again, 8, 10, maybe 12 names, and we're doing that in a meaningful way. But as the next slide will suggest, and that's Liz's slide, I mean, if you look at this, this is really interesting in terms of the concentration. 3-month correlation between the S&P 500 and the number of stocks advancing, as I was just sort of alluding to, has fallen below the dot-com era. I mean, think about that for a second. I mean, that, you don't want to compare this to the dot-com era, but you know what? You can compare it at least through this lens, Dan.
Yeah, and again, I think there's a lot of comparisons. I mean, one of the big ones that you hear all the time about the concentration, that it's very different this time, right? And so the companies that were driving a lot of the performance in the late 90s into the early 2000s, did not have the sort of moats. They didn't have the earnings growth. They didn't have the margins. And I get all that, but it doesn't mean that you can't have a bubble. We're going to put this in the show notes. Our friend Doug Cass from Seabreeze, who writes for Real Money, he sent us a note from Sequoia. Okay, this is Sequoia Capital, one of the most famous VC firms that have ever existed. And they're talking about, the bubble in AI investing in the private markets. And they're not even talking about the public markets. But if you think that there's starting to be calls from some very prominent VCs about the bubble in private market valuations, you can easily extend that to a narrowing group of publicly traded names that are trading, a few of them above 3 trillion in market cap, and there's a handful above 1 trillion in market cap, that are really, just kind of tied into this trade. So if there's ever a reason for investors to kind of take a pause here, if they're looking at Q3 guidance from some of these public names and they're talking about what are the use cases, what are the business models being built around this, how much redundancy is there, how much, spending, enterprise spending, it's kind of stealing from Peter to pay Paul, right? All those sorts of things. And that's the thing that I would be really worried about and bringing back to last summer, from late July, as we got into the thick of Q2 earnings, to the lows in October, we had a sustained sell-off in some of the biggest names, and many of the biggest names, Guy, sold off more than that 11% in the S&P 500.
No, and it's amazing how quickly people forget that. I mean, let's just anecdotally, I mean, pull up a chart, and there are a couple names I'd love to look at, but put up a Facebook chart just real quick. I mean, we know what the disaster was in Facebook the first time around. The subsequent rally was heroic in a word. Then this downdraft, the last earnings report, when they announced, I think it was the last one, if not two ago, when they announced the spend, I mean, the downdraft in Facebook was significant in a word. And now we've not only gotten the entire thing back, but just made an all-time high today. Now, today is interesting, Dan, because look at the reversal just today in Facebook. So there's so many strange things going on. I mean, ServiceNow, I know, is a name you and I talked about earlier. You could throw that up just for illustration onto the extent of the moves when they report earnings to the downside, the subsequent rally seemingly on nothing, and then the subsequent sell-off when they report earnings again. I mean, it is really fascinating to watch.
Well, it's funny. Here are two instances, and you could throw up Netflix as a third one, and there's many other situations that, happened after Q2 guidance where there was big gaps in the stock. And I think that's a matter of expectations heading into earnings. And later on in the week, we'll spend some more time. JP Morgan reports, on Friday morning before the opening. But just think about where that stock has come from after its gap. Well, let's pull that one up here. So why is it that the day of earnings, these stocks or these, based on the company's guidance, had these huge gaps, and investors were so quickly to fill in the gaps and then make new highs? And that could be, there's a really good thread, and we'll put it in the show notes. This is from a guy named Bob Elliott, who's actually been on the program, Unlimited Funds here. And he's talking about these expectations. And I think this is really interesting. U.S. stocks experiencing a surge in earnings expectations, not actual earnings. So investors are set up for disappointment ahead. And he makes the case, whether it's earnings, whether it's sales, we can kind of scroll through this a little bit, but I want to kind of get towards the end of this thing. And I think it's really interesting about what he's saying. Ultimately, the cycle turns as those high expectations are not met in reality, and that creates a shift away from the growth assets, creating a negative wealth impact and slowing spending. This looks to be what is most likely to play out between now and say the end of 2025. And what's interesting, Guy, is you've often said this. Okay, I think he's really speaking about enterprise, but when you talk about a wealth effect, you're really talking about consumers. You're talking about people who are exposed to risk assets. And in this case, some of the ones that they can't think of a reason why NVIDIA or Microsoft or Taiwan Semi or Google or Amazon or Meta should sell off or have a sustained sell-off. And the point is, we've seen some divergences. That's what we've been talking about right here. But when correlations go to one, when investors have a whole host of reasons to sell, there's no price that makes sense in the near term to start stepping in and buying buying.
No, I agree with that. And it's interesting. I mean, I think what's happening now is, and if you watch, and I'm sure I'm guilty of a lot of things, but one of the things I won't be guilty of is just sort of putting the pom-poms out. And I think what a lot of the bulls, and they've all been, by the way, correct for whatever reason. I mean, what they'll do is, they have the end game, like they have the answer, and they try to sort of find their way into the answer, and they'll try to do it around earnings expectations and earnings growth. But the reality is, I think in large part what we're seeing is just a momentum trade, and that just continues. And that's what I've missed clearly, the momentum behind this market and the amount of money that's sort of flooding its way in. Or I guess not only the amount of money, but the lack of selling on the other side that has, basically allowing these stocks to have these these moves to the upside that are just, there are no guardrails whatsoever, and there are no speed bumps, which historically, doesn't really happen all that often, but we're in the midst of it now.
Yeah, and going back to some of these confirmations. So again, if you're thinking about the economy and you're thinking how correlated the stock market is, but then again, the dispersion between the semis and the trades associated to AI. Look at the IYT. That's the ETF that tracks the transports. Never confirmed a new high in the S&P. It's down 10%. The XLE is down high single digits, I think, from its recent highs, about 10%. Also, Guy, right? XLI never made a new. That's industrials. Never made a new high with the S&P, as the S&P is blowing out. So what does that say to you about growth, right? And so I want to pull up this slide. This is from the transcript. This is a service that I use and I think is really great. And they do a really nice job of pulling out some important data from some corporate transcripts, or in this case, this is a U.S. a Federal Reserve governor here. Recent data, including first quarter household spending and retail sales for April and May, suggests the growth is slowing. And in April, the total amount of credit card balances and other types of revolving consumer debt declined for the first time since 2021. Signs of strain continue to emerge among consumers with low to moderate incomes as their liquid savings and assets to credit increasingly become exhausted. Credit card delinquencies this is really important, is on the upward trend, and the rate in which auto loans are transitioning into delinquencies is at a 13-year high. These rates are not yet concerning for the overall economy, but bear watching. And, it's interesting because those were some of the things we heard out of Fed speakers back in 2007, how subprime was contained. But again, I think that one of the things that I want to take away is that, signs of strain continue to emerge among consumers with low to moderate incomes. There are two economies right now. Those with low to moderate incomes and those on the higher end who are exposed to some of this risk asset appreciation and housing.
This all makes sense to me. But I would have said the same thing 6, 7 months ago that we would have been seeing this. Now we're starting to see it. Okay, so we've talked about the amount of consumer debt that's out there, and now they're talking about that debt is slowing, which makes sense. I mean, what probably is happening, banks, creditors are pulling back, not allowing customers to push that far out, I guess, on the credit curve. And then the next thing that really is concerning, transition delinquency is a 13-year high. I mean, that's something you really have to watch because it does speaks to the consumer running out of gas, no pun intended here. And I don't think enough people are paying attention to it. So I've said for a while, consumers are fighting inflation with credit. They've been allowed to do that. Now, seemingly, they're not being allowed to do it. And there's just some decisions going to be made. And that's going to mean delinquencies go up, which should mean reserve ratios start to go up with the banks. And maybe we'll hear it this quarter from JP Morgan. I think JP Morgan, Citi, and Wells on Friday, or maybe it'll be next quarter, but I guarantee you that's something that everybody should be on the lookout for.
Yeah, no doubt. Really quickly on the Friday jobs report, I think this is interesting from the Daily Shot. They're talking about really the disparity between private jobs and government jobs. And again, I don't know if you and Liz hit that this morning. I hadn't had the opportunity to listen yet, but again, government spending has obviously been a really big part of this economic rebound after COVID. And again, that was by design, right? The Fed's raising interest rates, in 2022 into early last year. It was meant to slow down the pace of the economy, which we really haven't started to see until very recently. But without the government, with all this hiring, guy, we're probably well above 4% or 4.1% unemployment.
100% that's the case. And that's something else that I probably didn't take into full account because I thought, again, in the fall of last year, we'd be talking by this time, July, of an unemployment rate that would be north of 4.5%, approaching 5%, and that's obviously not happening. With that said, it is starting to tick up. And, something that I brought up for months now is that revisions to the downside, I think 13 in the last 15 months or so, the revisions to the downside have been, in a word, pretty extraordinary. I don't think the market's taking those into consideration. And I do think the labor market is not nearly as strong as the unemployment rate suggests, and some of the pundits would suggest as well. I think there's some real damage being done under the surface, and you alluded to it just in terms of government jobs, but there are other things going on as well in terms of part-time jobs. And, again, the market doesn't seem to care, but when maybe the market cares all at once with all the things we talked about, but hasn't happened yet.
Yeah, so this is something interesting. It caught my eye today, Guy. So you have an S&P and a NASDAQ unchanged today. You have a VIX that's below 12.5. This is after a big week, as we just mentioned in the market. The S&P, was up, I think, close to 2%. The NASDAQ last week was up 3.5%. Look at this, okay? This is the So, on my main FactSet screen, you've seen it. I kind of use a little bit of a heat map. I have, 300 tickers. I have them separated by subsector and the like here. Look at what's going on in the semis today, Guy. Okay. These are the top 10 holdings in the SMH, which is up 1.6% today. Now they're coming off the highs a little bit. I think NVIDIA at one point was up 4%. It's only up, 2% or so on the day. But then look at software. And this is an area that we've kind of talked about a lot. And again, not confirming the highs in the S&P 500 and many of these names. Obviously, Microsoft is a huge holding, which definitely has, but it's really outperformed many of these other names in the SaaS space and the like. And we took a look at that ServiceNow and got back to the highs, which should never be there based on valuation and the like. So again, what does this say to you that on an unchanged day in the NASDAQ, we have this massive outperformance in the semis again, and then underperformance in the software space?
That's been the theme now for the last month and a half, 2 months. And, again, on days like today, when you see it, when you visualize it, it makes it a lot clearer in terms of what's going on. So you can say there's no rotation. Then you look at this, like you say, wait a second, clearly there's something going on. But, what I've said for a while is software is getting it on two fronts. They're getting it on the CapEx front because all the CapEx seems to be going to AI. And they're also getting it on the market side of the equation, the investment front, because all the investment dollars are going to AI and they're getting taken out of software. So when you have that double whammy is when you see days like that. Now, here's the IGV. We're right back to those levels. This is where we theoretically should stall out. But then you put up the semi chart and you'll see this uptrend's been in place for quite some time. And every time we sort of get down to that sort of short-term trend line, we bounce. I thought, again, incorrectly, that we approached that moving average, the 200-day moving average earlier this year. We got maybe sort of close in April, not really. I think the 50-day moving average lined up there, but here we are again, a couple standard deviations away.
Yeah, to that point, I mean, this is 40% above its 200-day moving average. NVIDIA, which is the largest holding, is up, I think, close to 75% above its 200-day moving average. And then the IGV, which you just mentioned, Guy, is only up, I think, about 13 or so percent above its 200-day. And not a lot of that has just come in the last month. And then the QQQ, we just talked about how the S&P is about 13%, but the NASDAQ 100 is up about 18%. So things are getting pretty goofy as it relates to the outperformance in a few in tech, but then obviously in semiconductors. All right, guys, should we take a few calls before
we will? And before we take a couple questions, I'll say, it is some of the reversals that we talked about earlier are worth watching for sure. Again, I don't want to make a big deal out of it now because we're not, we got 2.5 hours left in the day or so, but keep an eye. So when you see moves of that magnitude, like the reversal in Facebook, for example, I think that's something to watch. And, again, see how NVIDIA closes the day. I'll say again, that reversal that we saw a couple weeks ago is still in place from that prior all-time high, I think either side of 140. So keep that in mind as well. So let's go to some questions. Kevin Mendoza, Guy, is WBA heading to penny stock territory? That's obviously Walgreens Boots Alliance. I mean, we've talked about this. You want to throw a chart up. I mean, I don't know if it's getting down to penny stock, but they clearly have significant issues here. And, I thought that when they brought in the new CEO a couple of years ago, I thought she was going to do a good job. And it seemed like they were figuring it out, but obviously they've fallen on a hard time. So there's nothing here compelling to me, at least, Dan. And I haven't seen the volume to suggest you should be playing this one for a bounce.
Well, good question about penny stocks. When you look at this, the market capitalization is basically $9.3 billion, and they have $33.5 billion in debt. And you start saying to yourself, how does a company like this earn its way out of this? And it just can't, basically, you know what I mean? So, the idea that they might need to reorganize or something, makes perfect sense. Here's a company that, it's expected to have an earnings decline year over year, about 29%, down again the next year. If you just want to look at revenue, expected to be up low single digits. So this company is seeing, revenue growth, but earnings decline. That's not particularly great. All right, what else we got there, G?
So this is interesting. This is from JM460. Are the big job report revisions normal? Read that California 2023 jobs added just revised to a loss for 2023. I've said this for a while as well. California, if it was an economy, I think would be the 5th largest economy in the world, number one. Number two, I think the unemployment rate in the state of California, I want to say is north of 5%. Don't at me. You might be able to check with Kensho or something. But I'll also say this. The importance of that is California typically leads the broader U.S. by about 6 to 8 months. So I think you got to pay attention to what's going on in California. And I didn't realize there were significant revisions for 2023. But that just adds to the point that I'm trying to make, I guess.
Yeah, no doubt. All right. Well, I don't have much to add.
No, I know. I just wanted to throw that out there. Scott A saying, just want to know, guys, thoughts about gold. Again, dollar yen traded north of 161 last week. I think JGBs are at a 13-year high. I keep mentioning Japan because I do think that's still an epicenter of a lot of the stuff that's going on. Gold is lower today. Gold's been up and down, but it's been hanging in there. And, I don't think this trade is over at all. I still think we're just biding our time here and just treading water for the next leg higher. So I don't know if this sideways action means anything to you, Dan. I think we're just sort of building a bit of a base here for the next leg. Other people would say we're sort of stalling. That's what makes markets.
Yeah, it's interesting. Bitcoin, maybe they want to pull that up a little bit, has had a bad run of late. The dollar's come off. I want to say the U.S. Dollar index, the Dixie, has gone from 106 basically just to below 105. You tell me if the dollar continues to go back to 104, then you probably have gold pressing up a little bit against those recent highs, right? And then if rate cuts start gaining steam, right, then you probably see the dollar go lower, you see yields go lower, and you probably see gold that go back higher.
One would think. I mean, and that's been my look. I mean, my view about gold is really it's X rates, it's X dollar. It's got a lot to do with what's going on in Japan and central banks buying gold. But, right now I just think we're sort of sideways waiting for the next leg higher. Wavy McFly, who's here every day. It's beginning to look like NVIDIA started to inversely trade the rest of the Mag 7. Have you guys noticed that the past couple of weeks? Well, I didn't notice a lot last week, but it does seem like, there are days where NVIDIA wins and other people lose without question. I mean, I'll go there. I mean, we might be at that stage of the market where it's not just a rotation into those 7 or 10 names. It's a rotation into now 2 or 3 names at the expense of everything else. But I'll say again, and you look at that reversal day, if you go to that, if you move the cursor and you can see that reversal day, it looks go one over the other way. Boom, that one. So that was that one. So that was on June 8th. What was that day? Thank you. June 20th. Correct. That's still intact. And that looks just like we saw on March 8th. If you go back to March 8th, you'll see that we made that reversal. NVIDIA traded sort of sideways for a period of time, and then it fell out of bed into April. So I think that's the same type of move you're seeing now, Dan.
Yeah, I mean, the one thing I would just say is that back in April, you did see a retest of that intraday high, from March. Well, I guess it was in March, late March. And so, listen, if you're long this thing, you may want to use like a 120 stop in the near term because they don't report in this, regular, cycle, but 40% of their sales come from Microsoft, Amazon, Google, and Meta. And they're all going to report that last week in July. And, if there's any disappointing guidance, I mean, this stock is going to be below 120, possibly on its way to fill in a couple of those gaps that you see there just above 100. And I know that sounds crazy, but I think that people just don't remember, this was a hot stock during the metaverse craze. It was a hot stock during the crypto mining phase. It had material, sell-offs back then. And then going back to, the spring from the March high that you highlight on March 8th or so to its lows in April, the stock was down 22%, right? So again, 140 down to 128, we're down 8-9%. At one point, we were down from 140 down to 119 or something like that. That was a real sell-off. So, I just watch the downside there. Use your stops, and unless you're just one of these true believers, you don't think it's ever going to come in, Guy.
Last questions from Pao Kai. What are the next support levels in the S&P 500 if we get in a correction? I mean, you can throw an S&P chart up again. I think we had one with a trend line. Look, I mean, the real support is significantly lower than where we're currently trading. I mean, that's the first support level there. I guess that's probably 53 and change, 53.50 or so. But the real support probably comes in the form of the 200-day moving average, which is probably around 48.50, 4,900 in my opinion.
Yeah, throw up a 6-month chart if those guys can do it really quickly, the SPX. And I see what you see as far as those moving averages, Guy. I mean, to me, there's that gap that we had, and I want to say it was in early June. It was June 11th. Okay, if you guys can put your cursor over there. I mean, to me, that would probably be the first line of defense if you want. I mean, you could also say that kind of, that level that we just kind of moved higher over the last 4 days. But the price action that you're seeing over the last few days, I mean, that's something that most certainly is likely to correct. We're likely to go back to 5,400, maybe that rising 50-day, as it moves a bit higher, maybe that's, kind of 55, 25 or something like that. But to me, I think you're correct. I mean, I think if you just take 10% off of this 55.70, you can do the math. It gets you down to 5,000, which is, it's the 200-day moving average, Guy. By the time it gets there, it's probably there. 5,000.
Yeah, makes sense. That's it. Because as you can tell, I got my tie on, which means I got to hop into New York, steaming hot New York City. That's going to be a fun ride. We'll be back tomorrow. As Dan said, probably the last Monday, not probably, the last Monday for market call for a while, unless, again, you have some extraordinary market move, which we will alert you on the day if it happens. But check out Market Matrix as well, Dan, because I think this is now week 8.
Yeah, this is great. I mean, we're really enjoying this, and Guy and I and our team are curating what we think are probably the 10 most important stories as it relates to the market, the economy, throughout the day. We put it into one of these large language models. We get a nice little summary. We get the text. Then we throw it into another AI voice bot. And there you go. You get this kind of podcast in under 10 minutes. Our main man Brunson is reading it to you. You don't even have to listen to Guy and me anymore. And the other thing is, Guy, I know you do this. Listen to it at 1.5 speed. You know what I mean? You're going to get this thing done a lot quicker. So it's a really fun thing. It's growing really nicely. Download it, rate it, review it, follow it, share it, all that sort of thing. So we appreciate you.
Enjoyed this. Lori Calvasina will be on the tape this week. That'll drop on Friday. I mentioned her earlier. We'll ask her about her price target. And that's it, Dan. We'll chat tomorrow.
All right. See you guys tomorrow. Thanks.